As a creator, this is going to let you reach a lot more people around the world, no matter what language you speak. So now you're going to be able to take your content and it's going to be in your authentic voice, speaking other languages if you want. And we're also doing automatic lip syncing. So it actually looks like you are speaking the other language.
You think if you've got an e-commerce product and you could only sell to the Western countries because it's English, now this is going to open up selling to everyone just because of like to click your fingers, you can now apply to any language.
I guess their point of difference is that they are putting up their network, the likes of Sam Kerr, to actually be sales and marketing for those portfolio companies. So they really have thought about, well, what can we bring to the table? How can we be different? What value can we add beyond just writing a check?
I don't know if I told you guys this, but Vu said that the Tom Waterhouse podcast was the best podcast he has ever listened to, and he's listened to it multiple times. And for him, it wasn't so much the insights into how Tom set up the options element. It was actually about the value add piece. So choosing companies where they can very clearly add significant value to the company beyond the capital. This is where VC has to go, is differentiated value add.
Now, people often say there's no I in team. That's bullshit. There is an I in team. It's just hidden in the A-hole.
Oh, you done well there, Don.
Capitalize, think of the A, and then inside that A, you've got an I, and it's hidden in the A-hole. Good morning, all.
Good morning.
Morning, guys.
How are we?
Jack's back.
Jack is back.
How's the renovation? Are you going to apply for the block?
Nah, this is a one and done. I don't know how people can just keep flipping.
Oh, I'm totally there for it. I would go on the block if I had someone who had tradie skills in my life.
I think the reason why people keep flipping houses is the reason why people keep having multiple children. You forget the pain.
Yeah, you get the elation at the end and forget how hard it was at the start.
So your other half is not handy, Ash? Is that what that prior comment implied?
Oh, he's very handy at lots of other things. He's relatively handy, but not handy enough to go on the block. Do you really want a tradie?
I think the block would be a real test of any relationship.
Well, we had 10-13 runway event last week.
Oh, as always, epic event and so good to catch up with everyone. But Stu and the team delivered another exceptional one. Good lineup of speakers, some interesting content. But more than anything, like we always say about these events, it's those conversations that happen on the side, the chance to catch up with people. It was just absolutely phenomenal.
It was really, really good to catch up with everyone. Jack, Bernie Woodcroft was there and pulled us aside and said that really there's only two intelligent people on the podcast now. That's you and Ash. And if half of you don't prepare, i.e. For this theme of the week, it gets very disappointing.
Yeah, so I've made sure I've got a theme of the week.
It is weird walking around an event and everyone referencing the podcast, and they reference things that I'd totally forgotten about or that we'd spoken about. I feel like they know us better than we know ourselves. It's a little bit scary.
I'm still in like this disbelief phase where like Don keeps like, yeah, I met another person that listens to the podcast. It's like, really? Is there actually anyone who listens to this?
Yeah. Why? What's wrong with you?
I was talking to Peter and Prue, and it reminded me of this little video, given the way that I'm treated on these episodes sometimes.
Each time when I come here, I am abused.
They just feel the talk around my administration skills is just a little bit too much, and they just feel that it's unfair.
Don, did you thank them kindly?
From my humble position, Jack, of course I did.
Was there a standout speaker?
For me, one of the highlights was Bonnie Hancock, who spoke about her paddle around Australia, and just that reminder of human resilience. And there were so many parallels between that and being a founder. And then the other good one was just catching up with Vu Tran. So we had a chance to have some really good chats around what he's working on now in defense and why defense, and also his view on AI, which is very similar to our thesis. And so, yeah, I think those types of conversations where you get deep into topics, like particularly the defense side, it's not a space that I'm particularly across, but his insights into that and why was really powerful. So he's agreed to come back on and record another episode with us to talk about all those things as well.
The speakers that I saw was great, but I got to do a shout out to like the sound and video guy. He had the cricket on a separate TV the whole time, and he had one ear on the stage, but two eyes on the cricket. And there was just a whole group of people standing behind the sound engineer watching the cricket in parallel to listening to all the insights.
I particularly loved it because there was some guy on stage talking about his $180 million exit, and these guys just gave no fucks. They were watching
Couldn't
the
give a
cricket.
shit watching the cricket.
It was so good.
Well, let's get into a few things. So just recapping, it's not even a recap. It's sort of like, let's go and look at what AI is doing today. Like I just thought I would share this, and it's Google's Med-Gemini. It was a post just showing where somebody put a conversation up where they went, "Hello, I'm a primary care physician. This is a chest x-ray for a patient of mine. The formal radiology report is still pending, and I would like some help to understand the x-ray. Please write a radiology report for me." And it just comes back with the findings. The heart is at the upper limits of normal size. Like it just rattles off all of these things. And there's a follow-up question: what evidence do you see of degenerative changes? And then it lists out mild degenerative changes are noted along the lower thoracic spine. This is where we're at today. Where are we going to be tomorrow, I guess is the broad question.
And the thing about that, Don, like that's only one application. Like Aaron and I were talking to a founder yesterday, and the same applies, like image to prompt for engineering. And there are just so many other professions where it's a skilled professional that could easily be replaced. Like that, the identification part.
Yeah, it's such a good point. And we've spoken previously about some of the weird quirks that come out of this, like with the AI in law, for example, generating cases and case law that doesn't actually exist. So, but founders often then anchor to that as a reason why AI won't win in these types of applications. But this is where we're at right now. And these models are self-improving, and they're also getting feedback from user interaction. So they'll continue to improve at an exponential rate. And so this is just the beginning.
I think the mental model for AI is like today is the worst it's ever going to be. Like it's only going to be better tomorrow. So you can't anchor on the fact of what it's been. And you've got to assume that it's going to be 100 to 1,000x better.
Yeah, exponential growth. People forget it's only been recent that we've all jumped on ChatGPT, these tools. They're quite recent, and look at how far they've come in that time, and extrapolate that at an accelerating rate. And I think that's...
Yeah, and the rate limiter right now is silicon and data centers. Like it's not the technology, it's the infrastructure.
This next one, when I first saw it, I had a little bit of a chuckle, but when you actually extrapolate it out in terms of building a global business, being able to hire people, like just so many different things, that if language wasn't a barrier and in real time, you were able to just meet in the middle based on your language. So this is Zuckerberg presenting a new feature in Instagram.
We are experimenting with automatic video dubbing on Reels, starting with English and Spanish. So this is going to be a way that you can see more of the content that's out there, no matter what language you speak. And as a creator, this is going to let you reach a lot more people around the world, no matter what language you speak. So now you're going to be able to take your content, and it's going to be in your authentic voice, speaking other languages if you want. And we're also doing automatic lip syncing, so it actually looks like you are speaking the other language. So let's check this one out.
De coco, banana y dulce de leche. Esta receta fue una de las primeras que subí a las redes. Hace poquito la volví a descubrir y le hice un par de modificaciones para que sea aún más deliciosa. With coconut, banana, and dulce de leche. This recipe was one of the first ones I uploaded to social media. A little while ago, I rediscovered it and made a couple of modifications to make it even more delicious.
Like it seems really basic. I don't know. I think that's transformational.
Yeah.
Oh, absolutely. Like you think if you got an e-commerce product and you could only sell to the Western countries because it's English, now this is going to open up selling to everyone just because of like to click your fingers, you can now apply to any language.
I know 3 startups in Queensland that just killed. Like they were translation services that are now no longer needed.
I think it's amazing. And I also think that if you're able to start doing stuff like this, it's also going to open up even more potential impact in the neurodiverse space as well. There's just so many parallels of how this can help people understand content, break content down, slow it down, like just so many different avenues. But to be able to be a creator in this economy as well, I think that just opens up your global reach. And there are some incredible creators out there that I think this will really elevate their platform. And it's exciting to see how that goes. It's a creator-led economy. And I think that's it's a new ecosystem that I'm glad the power shift is back in the hands of the people who are actually creating the content, and people want to hear their voice, not the brand's voice.
Now, we can't get too ahead of ourselves. I saw a post, AI will probably take over the world and end us all in the future. But also AI camera mistakes referee's bald head for the ball and follows it throughout the match.
Oh, this is just like HBO Silicon Valley with the hot dog, not hot dog. But maybe AI was like, it actually knew that fans might actually prefer to follow the referee's bald head than watch the game of soccer. It was optimizing for views.
To your earlier point, a lot of people that want to deny things, I think, anchor on it, like some of the screw ups and even like the hallucinations. Well, actually, they're now building into the tools the ability to cross-reference and go and check. So there's now new layers coming in to reduce hallucinations, and one day that disappears. Now, one of the things that AI is leading to is growth in a whole lot of areas. And this year's fastest growing companies list by AFR has come out. And it's a big list of 100 companies. The top company was Medevac Flights with 707% growth. Intrepid Travel, nearly 400%. Pay.com, 380%. And we'll talk about a few of the names all the way down to the bottom of the list is still 25% growth. That's Orcoda. That's actually a Brisbane company, a small cap that does SaaS for transport. Yeah. Did you get a chance to have a look at some of those?
Yeah, we did. And one thing I wasn't clear on was criteria. Obviously, there'd be some companies whose data wouldn't be accessible for them to even appear on this list that are growing.
Well, here's the thing, not wanting to be one of those dickheads, that this list isn't the fastest growing companies. This is the list of companies that applied to be put on the list and their growth rates.
Yeah, right. So that was right. And also from what base? Like when these growth stats, we can point to companies that have grown at 300% plus, but they're coming off almost a zero base. So those numbers are distorted. Well, not distorted.
Can't we just enjoy a good list?
Sorry. Oh, sorry.
It's just
not like me to be negative.
This is not in the Sharts section, so we are allowed to digest and pull it apart.
Right. I see where you're going.
Thanks, Ash.
You're welcome. It's a good list, and it's good to take a moment and celebrate that these companies are doing so well, but I wouldn't much more time on it than that.
Yeah, it is interesting that we kind of report on this growth number, but there are so many other elements to look at within the business, and there's nothing to say that these companies are growing healthily on those rates.
Well, I think that's the key thing is as a world, let's face it, venture capital, the main focus in life is growth. We celebrate growth. I guess where we try and take a little bit of a different view is we need growth, but we want growth to be the outcome of healthy development. Because if you develop in a healthy manner, you're far less likely to come to a bad outcome. And we'll talk about one example later. But if you develop in a healthy manner, growth is a probable outcome. I would rather see companies grow slower, but really in a healthy manner. And what you'll find, if you've got a really healthy company at the time of exit, whether it's listing or acquisition, if you can demonstrate real health, real foundational strength, and this ability to demonstrate resilience, we actually do find that you get rewarded for that. Have growth as a deterministic goal, but a constraint goal has to be that healthy development. Now, we look at a range of metrics, but a new metric has been born by Sir Edward Keelan out of the UK, and that metric is the SER metric, SER, Salary Efficiency Ratio. Have we had a chance to have a look at this?
Yeah, I love this. Sir Ed, SER. Sir Ed, I like that.
I thought it was an awesome article. Having looked after the hiring for 11.2 for a couple of years, this is a great ratio. And it's always, particularly when it comes to annual review time or even just people asking for benchmark of how they're going, because it is a consulting service, this is even more important But then extrapolating that out to our portfolio companies and understanding if you're going to go into a new market, how does this impact your growth rate, your trajectories, how you've actually thought about the team landing on the ground. Yeah, I think it's an awesome article, and I think everyone should go and read it. I sent it to probably 15 people in my network as soon as it was in our group chat.
Well, Ed's going to come back on the podcast and unpack it with us. So you'll get to meet Ed. He's a great VC out of London. I might just read a couple of bits. I love a good ratio, says Ed. And fortunately, in the world of SaaS, we've got loads of them. ARR, LTV to CAC, rule of 40, magic number, you name it. It's got a ratio. With the exception of one critical piece. I've been dreaming of a ratio that can tell me at a glance whether a company's spending too much money on its most important and often most expensive asset, its people. Alas, one has failed to materialize. As I'll explain later, ARR per employee doesn't cut it, which is why I've come up with something myself, introducing the salary efficiency ratio, SER. And essentially, it just is annual reoccurring employee expense, AREE, divided by your annual reoccurring revenue, ARR. But what about ARR per employee to engage employee efficiency? I hear people shout. Well, this metric on its own isn't sufficient. ARR per employee only provides a snapshot of how much revenue is being generated by each staff member without accounting for the cost of those employees. It tells you how much revenue is tied to each worker, but doesn't reveal how much you're spending to achieve that revenue. And yeah, we've just seen it so often that growth and LTV to CAC and rule of 40 and magic number, all of those can be good, but actually underneath you've got an unhealthy situation brewing. And I think this is going to be a really good ratio for founders and investors to add to their suite.
The thing I was keen to break down next was for the monthly employee compensation multiplied by 12 to get you your AREE. Is that just their compensation? Is that the overheads of having an office? Like actually understanding all of those other metrics as well, particularly when you think about the conversation we had with Ben at Employment Hero last week of being remote first. So therefore, if you are also putting in the overheads of having an office, as well as all those other little bits and pieces that are an employee expense to have them on the team, how does that then come into this equation as well, was something I was keen to understand.
Ed, if you're listening, please prepare accordingly.
It is a good point, Ash, because you look at some offices that are quite extravagant. But for me, I love this. For me, it comes back to the true essence of what differentiates a startup from a traditional business that is starting up. And that high leverage on labor has always been sprouted as the differentiator, like the ability with a relatively small labor force to actually scale revenues through the use of technology. But to actually tie this back to revenues rather than purely, employee cost rather than purely headcount is really valuable.
Looking at the investments we've co-invested with Hostplus, like something Ed said and he kept hammering home was build the machine before you scale. And like that relates here. Like this just goes back to managing your cost and have a really good understanding of what it takes to then scale profitably.
Yeah, no, agreed. Well, I look forward to getting Ed on the podcast and we'll do a full deep dive unpack. You know how you're listening to a podcast and then it stops for an ad and it's really annoying? Well, that's what this is.
Oh, God. What are we doing ads for?
So from an investment perspective, what does Tribe invest in?
We invest in B2B tech companies post-revenue with scaling sales and the early inklings of their scalable sales engine that are looking to expand into the UK or US markets.
One of the main reasons I think Tribe is different is that we focus on a low volume of deals. We roll up our sleeves and add real value to our portfolio.
For sophisticated investors that are interested in investing to early stage technology companies that are scaling into global markets, we have both a fund that invests across a portfolio of ventures and also a syndication model where investors can choose the investments that they prefer on a deal by deal basis.
And enough of that, back to the podcast.
Now, there is a class of company that looks like it's going to need a lot less staff and therefore the SIR ratio is going to look pretty healthy. And those are AI companies. There was a post linking to an article that Kyle Poya had written And I think it really aligns to a few things that we have discussed. For those listening home, this is data sourced from Stripe, and it's looking at the median number of months that companies that have grown past 30 million in annualized revenue, how long it took them to get there, which is like over 60 months. But AI companies or AI first companies, it's actually just on 20 months. So the speed at which it's moving is just significant. The reason this has been put forward is that AI is actually giving way to a new business model that allows companies to actually charge based on, the article from Kyle says, we're moving away from charging for access to software and towards a model for charging for work delivered by a combination of software and AI agents. Technology companies are realizing that they can't solely rely on seat-based subscriptions in an age of AI. Perhaps Salesforce going all in on Agentforce and charging $2 per conversion was the push that the industry needed. The issue comes down to attribution. You want the customer to get a fantastic outcome, and you want them to recognize that your product powered that outcome. As soon as you start charging for success, the customer starts to rethink those results. Did your product really drive the outcome, or did they drive the outcome with a small assistance from your product? If your product relies on people to change their behavior in order to generate ROI, then success-based billing could set you way back. Ensure that your product is able to own the end-to-end and that you're able to align the measurement upfront. I think that aligns with what we believe is going to occur.
Yeah, absolutely aligns with what we've been talking about in our thesis. It was interesting chatting to Matty Myers, so founder of Vision 6 that got acquired by Clever Contacts. But he was talking about the future of that MailChimp kind of world. And he sees it absolutely switching to an outcome-based model. So rather than paying a subscription to sit on this data set that might not be utilized, if they actually clip the ticket on transaction outcomes, for example. So I can see this playing. And it's interesting looking at that list as well, Don, that you've got in the show notes. A lot of them are still, like it talks about disruptive AI pricing models, but some of them are still focused on the input side rather than actually the output. I think it's going to be more about the output side going forward.
Yeah, I've just put it up there. It just got Salesforce, Microsoft, Unify, Copy.ai, Zapier, all of these companies that are now starting to bring out outcome-based pricing.
Yeah, so it's still usage-based pricing, but then if there's an output, you can then demand a higher price, right? Like if it's just an input doing a KYC, whereas if it's an output generating revenue, you can then come back and renegotiate a higher price.
I agree. And I think because there's a few things happening in parallel. There's the AI aspect driving SaaS to zero, software to zero, but this verticalization, like vertical, deep integration in verticals. So like you said, KYC, Jack, like we've shifted from using KYC, a specific KYC tool into an embedded investor platform. And so the outcome being we're closing more capital through this platform, their ability to have pricing power to charge a clip of that ticket as opposed to charging a few dollars on a KYC check. And so I see the world going this way. The question is the timing, like how quickly will it get to this point? And I think the other factor at play here is VCs and investors who are still pushing founders on recurrings, which makes total sense, like subscription model, who may not be aware of this change. And so for founders to be able to start thinking now about what would our business look like in the future? How would we price things in this world? Should this eventuate in their particular sector?
And there is still like a gray area for us. Like we're investing into software companies on a SaaS multiple of the revenue. So it's quite hard for us because we're trying to time the right time. Like we're trying to get in at the entry and the exit at the same multiple, if not a higher. But if we're changing from recurring to usage based, we don't know how the market's going to price that in yet.
Yeah. What would be the exit multiple on a outcome? It's fascinating to think about.
Yeah, there was actually another article, Don, that I thought was super clear. It's got the pricing power ? It's about halfway down. And so from left to right, it talks about the ability to capture a large share of economic value that you create. Yeah, that's the one. And so it has your traditional on-prem model, then you go to subscription, then usage, then you buy units of work delivered by the product, And then as we we're just talking about, on the right-hand side, it's the success. You only play for those outcomes of work, so your return on investment. And I think this is a really good chart for people to have a look at and actually sit and digest, particularly when you've got newer players like a Snowflake who are already halfway down. And I can see them being able to flip their business model to success quite quickly and easily. But yeah, I think this is just a graphic where you could, if you are a founder, put where you are today, probably in that subscription bucket, and then think about what the model would need to change, or how can you get further down this line of economic value capture as you build your business.
After our podcast with Tom Humphries, I probably didn't realize how much value AI will capture. And he gave the example of CBA and how they've managed to, their dev team have become 40% more efficient. So if you times their annual salary, the average salary, by another 40%, like you can command a very high price for your products if that's what you're enabling the team. And for Intercom's sake, like they're getting rid of an offshore team and replacing it with FinChat or FinBot, whatever it's called. So you can command a higher price as long as the market doesn't become commoditized.
Yeah, and the big issue there is going from where you are today and making the decisions and forecasting the future and being able to make that change into that. It's I think if companies and founders could pause everything around them, make the changes they wanted, and then hit play, life would be a lot easier. But you've got to actually migrate internally and your external customers to new models, and that's where it gets really difficult.
And hence why we focus so much on developing the capability to navigate change loops while also building your business.
Anything else on that one, Ash or Jack? Yeah, and where we started was growth and the focus on growth, and obviously wanting to make sure we measure a range of things, and that's where I think that SIR ratio is important. And AI companies are obviously growing very, very quick, but if you don't develop in a healthy manner, if you don't actually manage the change loop well, if you don't actually get your internal culture humming around change, you do end up in a little bit of a challenge, and you can disappear. And there was some great reporting from Dan Van Boom from Capital Brief on Swoop Aero now ending up in liquidation. We'd previously reported they were in administration, having raised, was it 26 million overall? Like a fairly, I'll check that number, a fairly big amount. But Dan reports, when Swoop Aero touted a $100 million buyout in 2022 was meant to signal that the drone delivery startup's brightest days were ahead. Instead, it marked the beginning of the end. Last Tuesday, the company was placed into liquidation just a month after co-founder Eric Peck entered the company into voluntary administration, hoping for a revival. The collapse came 2 years after the startup raised 16 million Series B from investors including Main Sequence and Folklore Ventures. Peck contends the startup's challenges were exacerbated by VC backers, those stupid VCs, who partners occupied spots on the board. Administrators, however, PBS Reconstruction, put part of the blame on poor strategic management of the business. Multiple employees of the embattled startup told Capital Brief that its failure was not inevitable, but that poor leadership helped squander the opportunity it was afforded in 2022. The company's fate was sealed by a turbulent 2023, a year marked by product delays and shifting strategies, tensions at the top between leadership and investors, as well as between co-founders Peck and Joshua Tepper, ultimately filtered down to employees. Tepper quit in December, stepping down from the board alongside 3 of the shareholder directors. By that time, many employees had lost faith in Peck as the CEO. The article then goes on to list a whole lot of comments from staff. It talks about the sentiment of staff towards leadership, specifically that of Peck. It talks about some of the investors standing down. One of the comments I thought was interesting. I think we raised enough money, but what we didn't do was laser focus in. We kept trying to expand our territory. We just kept trying to grab all the apples off the tree, but were unable to actually do anything with them. How common is this problem?
Oh, totally. I'm reminded in here there's elements being described which are growth at all costs and unhealthy growth without integration and regular looking back in. Then there's a whole thing around internal conflict, taking energy from navigating everything else that is being thrown externally at the business and trying to, that distraction of time and energy that comes from that. It seems like there's a confluence of factors, and there always is. And also hindsight, the beauty of hindsight and sitting in the cheap seats, it's always easier to throw this type of commentary without knowing exactly what went on.
The article talks about investors who dominated the board were concerned that Kite's lack of progress and the company's high cash burn. Documents reviewed by Capital Breach show the board pushed the startup's leadership for a redundancy round and to allocate resources to manufacturing from other parts of its business. Those moves caused friction between Peck and the board. In April of last year, Peck suspended flight operations, protesting what he saw as unsafe reallocations of staff from operations to production, and threatened to resign. No wonder they're in trouble. Like, how much time are you actually spending on the business if there was that much conflict? Again, we are in the cheap seats, but there's like a common denominator here. It seems that the staff had lost faith in Peck, the shareholders had lost faith in Peck, the co-founder resigned and left Peck.
The board had lost faith. Yep.
I know it can be a challenge sometimes, but like if everyone around you is losing faith and saying you're wrong, I wonder at what point it's time to self-reflect.
Yeah, totally agree.
Jack and Ash, look at you, Jack, with your fucking ficus.
I was just going to say, when everyone around you says you've got terrible administration skills, it's time to self-reflect.
Right.
I think a weekend.
Well, to be fair, Don is not employed for his administration skills.
Exactly. Complementary teams. Thank you, Jack.
I like that you just had to get that in there, Jack.
I couldn't stop smiling.
It's one of those difficult things that I know investors, like here, they've let this founder CEO ride it all the way into administration. Like it is very difficult. I do think sometimes we overestimate the pain of removing CEOs and founders, because at a certain point in my experience, it becomes inevitable. And so by having leadership change, it doesn't guarantee success. But from what's described here, the inevitability of this occurring was a long time earlier. But again, we don't know what the control structures were and all of that. But there just seems to be a pattern here. I don't like the whole threatening of resign. I'm always reminded this when I hear someone has done that. This is what I'm reminded of.
Just asking you to have a think about your future with me, and know that if you keep getting in my way, I will have no hesitation in bringing that letter in here and resigning. Just want you to know that. Have a think about it. Be reasonable. I'm being reasonable. You're the one who's not giving you what I want. Think about it. I could be gone like that.
Like I think people have to take responsibility, and you're either in or you're out. And I personally don't like threats of resignation.
No, I agree with you on that one.
We don't only invest in B2B tech companies, we also run missions over to the US and the UK, as well as offsite, which we open up to the broader ecosystem. That's founders, that's investors.
Our missions are about taking founders and investors into the UK and US markets so that, one, they can understand what it takes to scale into those markets and set up shop in those markets, but also to see over the horizon into the latest tech, how capital's being allocated so that they can come back home and transform and scale their business.
Yeah, I like the way we put on panels of founders that have been there and done it, panels of investors. So then that way they get some time pitching to US or UK investors, the channel partners that we put them in touch with. It's really trying to get them into market so they can establish exactly what they need to do in order to scale a really great business over there.
Yeah, we really prioritize this not being tech tourism or something that you could simply YouTube or Google or GPT the answer to from home. It's really about experiencing and immersing in these environments where you viscerally experience scale. You get to understand disruption and how these technologies are actually being applied in market, and therefore how you can navigate and build a scalable business into those markets.
If this is something of interest, shoot us a DM. And enough of that, back to the podcast.
Sorry, that pause was me just getting some admin done. Well, let's see how it plays out. Let's change tack a little bit. With all this excitement in AI and a few transactions starting to occur, a lot of the media reporting is saying that a lot of investors are back. And I think that's demonstrated partly by not just the number of funds launching, because I think you could have lots of funds launching, but actually people are getting to first close. And some of the larger investors are really deploying. And there was an article in the AFR that says Hostplus $125 million VC bet signals Super's resurgent interest in startups. Major industry superannuation funds have struck 3 major venture capital deals in the last week, stoking hopes that retirement savings will underpin a resurgence of deal making. Did you get a chance to have a look at the one? We're going to rattle off a few other funds that have launched, but I'm getting the vibe that maybe 2025 is going to be a strong year.
Hope so. It'll be well timed for us with our fundraise.
Oh, have we launched a fund? Oh, weird. I didn't realize.
Yes, soft launch and the official launch early next year. But yeah, look, I think it's a positive from Hostplus. They did make news not that long ago that they're not looking at emerging fund managers. So this is very much playing into the larger, I don't want to say incumbents, but the Airtrees and such. Still a tiny amount of capital in terms of their total funds under management. Great signal. And yeah, the other articles that are ahead showing that I think it is starting to change, which is awesome.
It's exciting. It's good to see these early signals from the market. Obviously, we internally have been talking about the signals we've been looking for and the growth in those. So yeah, excited that we are launching in a market that is up and to the right. Hopefully it continues, and happy to take any calls from anyone that's interested in our fund. We're an emerging manager, which means we have hit it out the park. So it's a good bet, I say.
Yeah, I agree. And we've said it a few times on the podcast, like a good time to invest is often a bad time to raise. And like, I think we are exactly at that point in the market. Like vows are so friendly. There are really good companies that if we tried to get 2-3 years ago, we would have been paying a much higher price. But then the downside of that is it's just harder to square away a fund. But like, I'd much rather be in this environment than 2020.
Unless you're an elite athlete, and it seems they had no issue.
Yeah, well, we can jump to that. So the article in AFR says this VC for elite athletes is launching its first fund, and that ties into a post that Tyler Martin did. He was a former Olympian, founder, and now investor. His post says, "What the fuck do athletes know about raising a venture fund? Turns out we know enough to hit their first close." From the article itself, it says an investor community for professional Australian sports stars, which has backed the likes of Mexican-themed fast food chain GYG, Ozempic seller Eucalyptus, and electric golf buggy maker MGI is launching its first venture capital fund. Street Talk understands that Athletic Ventures, led by former AFL star Matt DeBoer and basketballer Matthew Dellavedova, has hit the pavement to raise at least $25 million for the early stage ESVCLP. I think the thing that popped out for me is it just demonstrates when you have a strong network and some domain expertise. Here, the network and the domain expertise of sports has come together for what seems to be on the face of it, a very quick raising.
They actually launched in 2020. And so they had been doing investments previously, it sounds, based on the article, where they were very much playing to the strengths of the athlete community, focus in the health and fitness industry. And so it seems that this launch of their first fund is actually going beyond the health and fitness industry. But the thing that I thought was very interesting, and you can see how they have very much pulled insights from the broader celebrity marketplace who invest in VC, is that their point of difference is that they are putting up their network. So the people who are actually investing, so obviously the two of them, but then the likes of Sam Kerr, to actually be sales and marketing for those portfolio companies. So they really have thought about, well, what can we bring to the table? How can we be different? What value can we add beyond just writing a check? Similar to us, obviously, they have a face that has some dollars associated to it. So Jack, pick up your game. But it's great to see that they've thought about their life beyond sport. And I think that's always something that people underestimate how hard it is to do while you are at the top of the game.
Aaron, it reminds me of the conversation you had with Vu about the Tom Waterhouse episode and the fact that it demonstrated that's where VC is going. It's not just money. It's how do you get the sales? How do you get the channels? How do you get the partnerships?
Yeah, Vu, I don't know if I told you guys this, but Vu said that the Tom Waterhouse podcast was the best podcast he has ever listened to, and he's listened to it multiple times. And for him, it wasn't so much the insights into how Tom set up the options element. It was actually about the value add piece. So choosing companies where they can very clearly add significant value to the company beyond the capital. And Vu's view, which is also ours, is, and exactly like you said, Ash, this is where VC has to go, is differentiated value add. And I'm also reminded of Jason Fielding, who's set up Voice Capital, which is for celebrities, so particularly those in acting and music, to invest in deep tech companies. So they're partnered with Main Sequence Ventures, but their value add is taking technology that can be spun out into a use case that can become essentially like a celebrity. And he talked about one that was a coffee tech company that's invented a new way to make coffee without actually having coffee beans. So it solves all the issues of child labor and environmental damage and so on. But then they spin it out into a consumer brand that a celebrity investor then endorses, and it becomes like a multiplier. And I really like it. It's a differentiated model. Makes a lot of sense.
Yeah, there's a bunch in liquor space in the US as well, wrapped in a private equity layer, which I think we'll see more and more of that over here. And some of the models I've seen over there is that it may not even be a celebrity that is owning it, but they may buy the rights of like Andy Warhol or something and leverage that as a brand. But I will say, if you haven't actually gone and had a look at what Ryan Reynolds has done in this ecosystem, that like he's done the playbook. It's incredible to see what he's done with his portfolio. But I do also want to give a shout out to the AV guys. They have not only thought about their differentiation in terms of what they can bring to companies, but they've gone and got Nick from Blackbird, Justin from EVP, as well as Ed from TDM on their advisory board. So they know where they need support. And I think that's something that we're always talking to founders about, but as investors as well, we talk about that daily. And so for them to actually go and get those hitters in the market, have support, I think is really impressive.
I'm also reminded the event with Brad Moran, like the parallels between professional sports people and entrepreneurship and making that leap, and some of the insights he shared around that. I love this model. I think it's the future of VC, are these types of models. High value add, differentiated. So well done.
And there was another announcement this week of a new fund. So Scale Investors, which to date has been a syndicate model focused on women-led startups, is raising a $100 million fund following a management buyout by 4 senior women executives. That will make it one of the few women-led venture funds in Australia targeting the gender funding gap. The buyout, which happened 18 months ago, transformed Scale from a not-for-profit to a for-profit venture firm. The new owners, Samar Michele, Rue Harris, Chelsea Newell, Solai Valiapan, are now leveraging Scale's existing portfolio of over 30 companies to attract institutional capital. The firm is aiming for a first close date for the new fund of April next year at 50 million. Data also shows women founders typically receive 2 to 4 times less capital than male counterparts and take 2 to 3 times longer to raise. Scale's track record includes some notable wins. Portfolio companies such as Trademark Vision delivered a 38x return, while Cognition Therapies achieved NASDAQ listing. Another portfolio company, Verve Super, was recently acquired by Future Super. The firm's hoping to write checks between $500,000 and $2 million, targeting early-stage companies with women co-founders who hold substantial equity and C-suite positions. Yeah, great to see that launching.
This is fantastic. Originally co-founded by Carol Schwartz and Laura McKenzie and others. And it's great to see something like this actually evolve and continue, like to outgrow. I don't know quite how to put it, but the original founding team, and just to continue to go on and do good things.
Well, I hope it works, because there's a similar playbook, starting with syndication, moving to fund. That's how we've started life, starting with syndication, move to fund. So we're absolutely in their corner and hope to see them really succeed and exceed that target.
I had a good chat with Samar, it would have been 6 months, 7 months ago now, just comparing notes on things, and heard some of their kind of vision of where they're heading. And so it's great to see this come to fruition.
And so there's large super funds investing in existing large funds. There's specialist funds looking at particular sectors, bringing expertise and networks. There's funds looking to invest based as gender being the underlying theme. But then there's also Micro-VCs. And there was a post from Alex Retzlaff. He's from Unify Ventures. He says, we love Micro-VCs. By love, I mean that through our fund of funds model, we specialize in Australian Micro-VCs. So we are constantly interacting with managers, some of whom are cautious about labeling themselves as Micro-VCs. My advice to them, own it. Doing so opens the door to driving the narrative fund size as a strategy, supported by examples such as this one published below, showing Micro-VCs' dominance among top quartile VCs. And to the concern of predictability, sometimes they are early indicators and track record. And now what Alex was referencing was a post from Akhil Paul talking about a $12 million fund returning 30x to investors, partly from the Service Titan IPO. The Mucker Capital Fund 1 was just 12 million and has delivered staggering returns, a $280 million payday. When Honey sold to PayPal for $4 billion, they held 7%. That's a 300 times returner. Then a recent $3 billion sale of Orderboard to HG. They were a seed investor. And then Service Titan, their upcoming $7 to $9 billion IPO crowns their portfolio. Mucker are up 650x on their initial investment. And yeah, so that's size as strategy compared to some of those other strategies. And there's some data that we're pulling as part of our fund launch that just demonstrates that actually there are top returns to be had based on size. And it makes sense. Whilst you couldn't compete on quantum against some of the really big, the big funds, the reality is they have to go and write larger checks, which often is at higher valuations. They often miss some of the upcoming deal flow. And that's why we're putting a lot of effort from a data science point of view and have Duncan on our team that's looking at getting into every nook and cranny of this early stage ecosystem to be able to find those deals that can become tomorrow's unicorns.
This is right on topic for us, right? We're talking about the type of differentiation that we're bringing to the table, and this is bang on. It's the data has shown and will continue to show, hopefully, with our fund being one of those pinup childs in the future of why micro funds work, and having the ability to make less investments, more hands-on. I think that's really what's going to set our fund apart. And I think our track record through the syndication, as well as just the team's ability to roll up their sleeves and help founders, is why I'm excited to be on the team, but also to launch our fund. So yeah, right on topic for me.
Not just to blow our own trumpet for a second, we are in the top 9% of our vintage to have actually returned capital to investors by this stage of our growth. So we're on track, but lots more to do.
Yeah, it was great seeing our GP update and that new line item of capital return to investors. That was exciting to see.
Yeah, it was nice to add 2 rows to the data we track for shareholders, exit and capital return to investors.
Well, let's go themes of the week.
I'll kick us off.
Yeah, Jack.
Yeah, so my theme, following on to the last one 2 weeks ago, so doing the renovation, the theme for me has definitely been managing your cost. And I think for founders listening, it's so important, especially if you're taking VC dollars, you've got to be so frugal and you've got to have a really good idea of what the cost base is of what you're doing. And to just to bring it back to what we're speaking about, from Ed's new article, managing the cost of employees, the biggest line item. The same applies for what I've been doing the reno. It's just making sure you've got such a good understanding and you're being as frugal as possible. And what does that look like? And what I've been doing, it means stripping down all the walls, all the corners, all the things that you don't need skilled labor, and then only getting the skilled labor and the specific thing just to bring down the cost. Or even battening the walls so I don't need an electrician to chase down the bricks. Anywhere I can save $1, I'm doing it right now. And I think it's so applicable to founders.
The 2021, 2022 days of just, you don't have to behave like that are gone. It's resourcefulness that leads to success, not resources. And long-term, durable, healthy companies actually have that kind of culture. And yeah, I totally agree, Jack.
And it's in the entrepreneurial DNA in some ways, but also for entrepreneurs that might be lacking in that administrative energy, if you're not naturally good or finding yourself, updating your cash flow forecasts and budgets to really have your finger on the pulse, get an expert to do it for you. But make sure you know those numbers and how you're tracking. Such a good point, Jack.
There's another part to that theme, Jack. One of my personal angel portfolio, unfortunately, one of them's bitten the dust and is shutting down. But it was a lot of investors talk about if there's no technical co-founder on the team, they don't invest. But why? Well, it's because there's no one on the team that can then go and do little developments or little changes. And actually what happened here, it was 2 great female founders, but they didn't actually control their tech. When they needed little changes, it was someone else. Then they got into, someone disappeared on them and they couldn't solve it themselves. And then with other portfolio companies in my early stage portfolio, those that can do their own little bits of marketing, they may not be guns, they may not be perfect, but they can actually do a whole lot of themselves, they win. But those that are relying on externals and aren't able to teach themselves or find a way to get that critical mass, they're the ones that don't survive. So absolutely right. Great. Ash, what was yours?
Mine's somewhat intertwined, but it is risk appetite. So my parents living in my investment property at the moment as they're doing renos, and they will be moving out sometime in March. And so now the question has come, do I Airbnb or do I find a renter? And that's made me think about my risk appetite as an investor much more. I hadn't really thought about ever putting it on Airbnb for a couple of years. And there comes risk of, I need to rent it out this many nights a week or this many nights a month in order to cover the mortgage, where I'd modeled it out in terms of this is what I need in rent to make sure it's offset, all of those good things. So I'm like my models, Jack. And so it just made me think about, particularly for our investors, how are they thinking about their risk appetite, particularly in this changing environment of AI or the fast-paced just trajectory of companies that I think are growing and shifting at greater rates of change than ever, with the future being very ambiguous. And that may be something that they haven't had the time or energy to be able to sit down and really form a thesis around, which I think sometimes then impacts their risk appetite to jump on deals. And so I think it's just made me think about the type of engagement we need to do with investors more and more, the type of articles, content, thought pieces, and just opinion pieces from us as a team to ensure that we're helping our investors and that ecosystem grow and shift with the changing environment more and more.
That's something that's been on my mind a lot, Ash, is our role in presenting deals to investors that they have an interest in confluence with educating investors on what we're seeing, because by virtue of us being 100% focused on this is all we do, we see things they don't. And it's an interesting point about investors developing their own thesis while still being open to inputs and new information. Mine's around attracting talent and incentivized behaviors. So speaking to some founders who are struggling to get good top A-grade talent into their venture, but it's partly because, to put it bluntly, like there's no real aspiration. There's no story people are buying into, number one. And number two, on the sales side, like attracting good sales talent, making sure that you're incentivizing for on the outcome as well, or at least incentivizing in some sense of ownership. So I think good talent wants to be part of something, doing something great, and they want to be pushed. They want to be challenged. And so even setting conservative numbers for sales and targets and that sort of thing, it actually can put good talent off. And it's interesting, like Myron just did her end of year review of her sales, and she's 2.5x her targets. And then they set the new targets for next year, and it's pretty much the same as last year. And she's like, fuck, I want to be pushed, like triple my targets. And that's the thing, good talent wants to be pushed. And so I think if you're a founder looking to attract good people, like have a compelling ambition, but also some compelling targets to drive them towards.
When you started that, Aaron, attracting good talent, I was like, oh.
But I think there's a good lesson here. So Ash and I, we're about like standing up ourselves, but like we're both not from the field. You guys took a punt on 2 people left the field. Like I had come from uni, studied law, didn't even know what VC was when you said you want to be an analyst. Ash had experience in hedge fund sales, not VC. You guys still took the punt, but I think like it's really up to the founders and the founding team to calibrate the culture and set the expectations. And you can't just assume you can hire the salesperson to come in and run and be the CRO that you expect them to be. Like you've got to set the demo, like set all the expectations, show them how to do it, and then like nurture them to go through. It's just not set and forget.
I think it's also flexibility though, right, Jack? Like having the flexibility for us to be in Adelaide as well, which comes back to Ben's topic from last week, right? Having remote first for them as a business has enabled them to open up all sorts of talent. And maybe that's something that these startups really need to think about if they are struggling in these areas. There are a lot of talented people that just can't make it to certain areas because of life challenges, location. So think broadly.
Yeah, and universally, we've heard Brad Moran, we've heard the Go One founders, like those that have achieved success, commonly referred to hiring for culture, hiring for attitude, and the actual experience in the domain can be built like that aspect.
Well, mine, I guess it's partly to do with all the reporting on Ben and Employment Hero and then doing the podcast with Ben. But then my role with portfolio support is in there with the teams. And a core part of how we help portfolio is getting them to understand that conflict is inevitable. And there's a difference, though, between constructive conflict and destructive conflict. And what we want is constructive conflict where 1 + 1 = 3. But it's just amazing that with conflict, that 2 humans or 2 groups of humans can see or experience exactly the same thing, but come out polar opposites. Like one group of people inside Employment Hero say, we absolutely love this place. And I think, what was it, after 5 years, 80% retention, which like that is very high for an early stage business. But then other people call it vile. They call it all of these other names. It's just amazing how that can happen.
Hi, it's us again quickly.
So these offsites that we talk about, where we get founders and investors in Australia together, what are they all about?
The offsites are really about the frameworks and tools to build a sustainable company in a healthy and durable way. So that's looking at the ingredients for a scalable sales machine, but also the ingredients to navigate the inevitable change and conflict that happens as you are scaling and building a high growth company.
The offsite's really for founders and their teams that have gotten over that product market fit phase. We're bringing our portfolio together with other founders. And so what happens is you get to really learn from a broad, diverse group of people that are all participating together. And a lot of the problems that they're facing before coming in is that they've got revenue, they've got levels of growth, but things just aren't working as well as they previously had, or they aren't going the way they want them to. And by sharing some tools and frameworks, just as importantly, the lessons from all the other founders and investors in the room, they then leave with networks that they can then call upon. You end up with 15 or 20 people that you can call and just touch base and get advice and connect with on that journey.
And as much as possible, we provide those frameworks and tools, but a lot of the insights also come from the fellow participants that are sitting across from one another at the table.
If this is something of interest, shoot us a DM. And enough of that, back to the podcast.
All right, well, let's get into some Sharts. This is the confidence I need in life. How to gain 1 million views in just 3 days. This is a YouTube video posted 2 years ago that's currently got 7 views.
Oh, you do have your confidence.
I love it.
That is me.
Thank you, team.
I've sent you a karaoke done. You've got so much confidence.
Yeah, okay. Sony owns a patent that would force viewers to exclaim the brand name during commercials to end them. Imagine if that was a thing, that you actually had to yell the brand name to make the commercial go away.
Like, did you fact check this?
No, of course not.
Oh, it's the Sharts.
It's the Sharts section, Ash.
Never let the facts get in the way of a good story, Ash.
I thought for the US political environment, this was funny. These smug pilots have lost touch with the regular passengers like us. Who thinks I should fly the plane?
Oh, that is
Like that.
that's such a good metaphor for the US.
God.
for a lot of things.
This is Elon Musk on Twitter. This is the posts. So for people at home, each dot is a post. And so he was pretty active. As soon as he bought the thing, he's just gone hell for leather. So he is single-handedly. I don't follow him on Twitter, but when I do have it downloaded, I'm always getting his posts. So he's obviously gamed the thing that everybody needs to hear his opinion.
Oh, he had to. He's got to cost a lot of money. He's got to pay it back.
Now, we're coming into the holiday season. Extra virgin olive oil, euros, price per metric ton is crashing. Like over the course of this year, it's from $9,000 a metric ton down to $5,000. Like that is a big fall. But you can just see it was exponential up. So from 2020, I guess people in lockdown were eating a lot of olives. It's gone from 2,000 to like 9,000. And now she's coming down.
I know what I'm getting for Secret Santa this year.
I thought this was an interesting stat, and this comes from someone I trust, so I didn't need to fact check it. But in recent decades, as a public company, your chances of survival is about 60 to 70% across the first 5 years. So that's interesting that like 30 to 40% of companies within 5 years of becoming public actually disappear. And the post makes the point that buy and hold works at the aggregate level and the index level, but the implication of this data is that holding individual companies, a lot of them drop off along the way. And that's where some of that challenge comes.
I really like that point, Don. It's good.
Yeah, that's where. And then the problem is the more and more indexes end up buying individual stocks, and you get these interesting market distortions. Now, as the stock market goes up, insiders are selling now at an all-time high, going back past 2004. So in the last 20 years, the insider sales of stock is at a record high. Now, that doesn't guarantee anything, but have a look at some of the different environments. Now, another person who sounds like doesn't really buy the whole situation is Buffett. Have a look at his cash hoard now. Berkshire's cash allocation has moved with market cycles. And so on this chart for listeners at home, it's got the dot-com crash, and you can see he had built up a lot of cash prior to dot-com. You can see he had built up a lot of cash prior to the financial crisis. And now he's building up cash again to like a record of nearly 30% of total assets sitting in cash.
By that chart, if the pattern plays true, we're a couple of years off him redeploying that.
Yeah, and that's his whole model, right? Is have really great companies, sit on a lot of cash, and then when things turn to shit. Now, some of the things that are worrying people, this is the US federal budget. This is a little bit old. It's 23, but we haven't finished 24 yet. But it's 4.4 trillion in revenue, 6.16 trillion in expenses. That's part of the challenge. But you can just see individual payroll taxes, corporate taxes, they're unbelievably small. And then you can see that deficit. And I think that's leading to a few people getting concerned. But I think why people are still fairly bullish about the US, because at the household level, have a look at the difference in debt to disposable income of Australia and Canada is like 190 and 175% respectively, versus the US that's only 97. So the US at the household level is actually underneath. Whereas, and I think it's because of our property, Australia and Canada's property markets have a lot of similarities. But yeah, I feel this. There's a big percentage of income going out on debt.
Yeah, same.
And you, Jack, and Aaron soon to be. So this is the salaries Americans say they consider the minimum to be financially successful. Boomers, 100K. Gen X, 212K. Millennials, 180K. Gen Z, 587K. Gen Z's got some serious expenses. The average is 270. It says that it comes from Empower. I'd love to know who is, but
I'm a Gen Z.
Yeah. Now, people often say there's no iron team. That's bullshit. There is an iron team. It's just hidden in the a-hole.
Oh, you never run that on.
Listeners,
And so for listeners at home, team spelled T-E-A-M, obviously, but capitalized. Think of the A, and then inside that A, you've got an I, and it's hidden in the A-hole. Those are our Sharts. So what are we looking forward to?
Yes, super close on captive fund deck. Got some early feedback from some of our network earlier this week, and have just been updating it and really excited just with every turn. I feel like it's getting stronger and stronger in terms of narrative, and we're getting very concise on what our point of difference is. And so that's, really exciting for that. And have a pretty quiet weekend, just a catch up. So I'm actually really excited for that.
Oh, I'm looking forward to seeing Adrian DeMarco on Friday, getting some feedback on our fundraise. Always a pleasure to catch up with him and get some good insights. And
Yes.
Yeah, he always gives the best feedback. Like, I'm looking forward to just hearing how the meeting went.
yeah, likewise. Always leave those meetings as feeling a foot taller and bulletproof. So
Yeah, he's one of those guys, like, it's all earned wisdom, and how many years it's taking him to build Tech One. He's seen so many problems. He's overcome it. Like, it's so good hanging around. And something like, because I've been doing the reno with my grandfather, he's been on the tools for 65 years and he hasn't seen, like, he's seen every possible problem. So it's just, he knows, it's just so much wisdom. And it's just so cool to see how he's like approaching all these problems, and he's done it all before. Like, you can't buy that wisdom. Like, you've got to earn it.
100%. And it just comes without ego. It's just coming from a place of genuine care.
Yeah. But I'm looking forward to, so I got a fair bit on. So got the renos, and then baby Louis arrives next Friday. So a lot to look forward to. And then got the whole
one
family
more podcast
down.
episode before you're a father.
So excited for you, Jack.
Yeah. So next Friday, if all goes well, Louis will arrive.
For listeners at home, last night I sent Jack a book, and the book title is "There Are Way Worse Dads Than You."
So I need to forward that on to Anna, who when she gets up there, can just...
I'm excited for meeting with Adrian, some of the fund stuff. And then today I've got like 3 portfolio support sessions. So really excited for that. Tomorrow, got another couple. So speaking of which, I was supposed to start one 7 minutes ago. So I'm going to say goodbye to you all.
All good.
Thanks, team.
All right,
guys.
team.
See yous.